Hello everybody, and welcome to the SMB Capital Options Training Program Trade of the Week. Today we are talking about the bearish butterfly trade. And the bearish butterfly trade is a wonderful trade that has been developed by a great friend of ours, John Locke, who will become a very active member of our options training community. John's a good friend of mine and a wonderful options trader who's developed some really great trading concepts over the years. So this is one of his ideas, and I've modified and played around with it a little bit, but I wanted to give credit to John, who did a great job on this. So let's go ahead and dig in. Basically, the premise behind this trade is that the market, regardless of whether it's selling off or not, even if it is trending upwards, the market always will have pullbacks. So if you position a trade bearishly and you do things in a correct and intelligent way, you can normally take advantage of the pullbacks and profit from those as options spread trades. This is a trade that does well if the market sells off right away. It's a trade that does well if the market runs up against us and then sells off. And the only scenario where it really seems to have trouble is where the market just grinds and grinds and grinds and grinds up slowly and does not have any meaningful pullback. And that can be a difficult month for this trade. So we're going to go ahead and give an example right now of a trade that we actually have on right now. This trade is live. It was initiated with 20% of the capital that we plan to put in it ultimately. So you need to set aside some capital for this trade. This trade was initiated on March 25th in the morning, when the Russell 2000 index, that index of small cap stocks, was trading at 822.80. We intentionally placed this trade bearishly at 20 points below the market, and so 8 weeks out from the trade on day 56 before expiration, we go ahead and we throw this trade on 20 points below the market, which is at the 800 strike. And we put this on the put side, by the way, although it could just as easily be put on the call side. We're intentionally bearish, and I'd like you to note the outstanding risk reward, which occurs 384%, so almost a 4-to-1 risk reward ratio on this butterfly, which is good stuff in options trading. Gives you a lot of room to work with, a lot of potential income to sort of spend if you need to adjust. So basically, the RUT, as you can see, was in an uptrend in the last week or 10 days or so. After having been on a tremendous uptrend over the last 6 months, it then sort of flattened out and had a sell-off as a result of the Libyan problems and the Japanese nuclear threat. And as soon as the market decided that maybe these weren't such a big deal to the overall world economy, the market began to rally again. So that's what was happening on March 25th. On March 31st, the Russell had indeed rallied up to 840. That's our first adjustment point. Now 40 points above our initial entry butterfly at the 800 level. So we're going to go ahead and add a second butterfly. This is the Russell before adjustment. As you can see now, we've added a second butterfly at a strike of 820, and that butterfly gives us this look, which I think looks a little bit like a nuclear power plant, as a matter of fact, so sort of appropriate symbolism. So we've widened the 10 out. Now we got 40% of our capital in the trade, now about a little bit more than, we started out with about 5,000, now we're up over 10,000. Now, the market then on April 12th, earlier this week, gave us the pullback that we were looking for. This is that sell-off, which is always a good thing for this trade. And as you can see, we put in $11,480 of capital so far. Our planned capital is about $25,000, and we got up to $23,440. And I decided to just kind of round that up to 10%, because 10% is the you wouldn't call it really the target profit on this trade, but it's the point at which you begin to lock down your profits on this trade. You still can make sometimes quite a bit more than that, but we don't want to now lose money on the trade if we're up 10%. So we're going to start locking down our profits here. And the way we do that with this trade, the way I've sort of decided to handle it, is to throw all of our capital. Once we're up about 10% of our planned capital, which again was $25,000, I want to go ahead and start to lock that down. So I'll take actually all of our capital to increase our theta, our time premium, and we're going to add capital to the trade so that we begin to get an additional kicker in terms of time decay that we are short, and therefore we will become more and more profitable as a result over time if the market cooperates and doesn't move around too much. If it does, then we've got ways of dealing with it. So we went ahead, and as you can see, this is where we are in the market pre-adjustment. We've got our roughly 10% gain. So we're going to restructure the trade, and this is how we're going to restructure it. We're going to turn the trade into a triple butterfly. We're going to completely change this from being a bearish trade to being essentially a neutral trade, and we're going to milk it. We're going to milk it. We're going to start adding capital to get the time premium. And so here's step one. We're going to take our original 800 butterfly. Remember, the market's at about 820 now. So we're going to take that original 800 butterfly. We're going to move that down to 790. So the first step is we'll have a butterfly at 790 and another one at 820, the original, or the second butter we had put on at 820. Then on the call side, we're going to go up to the call side and we're going to place a butterfly at 800, 850, and 900. In other words, an 850 butterfly. So we're going to have a butterfly at 790, at 820, and 850. So we got the profits surrounded, we've got the market surrounded, we're up 10%, and now what we're trying to do is create a nice, relatively flat delta scenario, flat T+0 line here, in order to create a situation where we're just milking time. Hopefully the market will stay, right here, right inside our very wide profitability graph, by the way, here, 776 to 867, and then just go ahead and let the trade breathe a little bit. And so about an hour later, on April 12th, I decided, just as a battlefield call, I wanted to lock down a little bit more of that profit, flatten things out a little bit more, because once I'm in this phase of the trade, my philosophy is that I do not want to give up more than 25% of my gain. I want the minimum to come out of this trade to be my having been up at least 7.5% against my planned capital on the trade. Well, as it turns out, that was a good idea, because the market sort of was stable, and we were looking to just sort of stay in the middle of the graph as much as possible, in the middle of the T+0 line as much as possible, and therefore at the end of each day I'm going to go in at about 3 o'clock, 3:30. I'm going to do that every day, and I have done that every day since April 12th, and I look at where we are, and this is an important graph right here. You can see this trade is just about perfect. This is a dream scenario in an options income trade, because we're right in the middle of the tent, so to speak. We're getting a lot of time decay every day. And so around 3 p.m. every day, my plan is to go in and measure what would be a 2 standard deviation move to either in either direction, up or down. And I play around with volatility a little bit, making sure to increase volatility to determine where my P&L would be on a down move. I'll increase it, and I will decrease it on an up move. And what I'm trying to determine is, will I be at least 75% of my maximum profit potential on the trade, maximum profit level on the trade that the trade has ever attained at the end of every day. I want to lock in at least 75% of that number. I'll stay in the trade, I'll stay at risk, but I don't want to give up more than 25% of my profit. So I'm looking at this every day around 3 o'clock. And if it turns out the market's moved hard to one side or another, then I will make whatever adjustment necessary, which is going to be in almost all cases the removal of a butterfly that's hurting me. And we can talk about that more when we get together and discuss this next time. But it will be actually removing capital to slowly extricate myself from the trade, locking in profit at each turn. So that is the position of our trade as of Wednesday, April 13th. And next week we will study what has happened to this trade. It's not clear we'll still be in it. If I get down to 75% of the maximum profit I've attained any day before we get together next, then I'm going to get out of this trade. What I'll do is I will keep careful records of that, and we'll go over exactly how this trade ended. But the idea is every day we'll be looking at where we are on this profitability graph and making sure that we don't put too much of the profit at risk. So that is the bearish butterfly. This one's going pretty well this month. Let's see how it turns out. We'll get together next time and discuss it. But as of this moment, we are up, let's see, that's about 15% on our planned capital. And I'm hoping for a lot more, but we'll see. Could end up being less. Just have to see what the market does. So folks, if you have any questions about this trade, be delighted to answer them. Just send me an email at sfreudberg@smbcap.com. We're available on Twitter, SethF at SMB, and please check out our blog, SMBtraining.com blog, and you'll be able to see this video, which will be posted on that blog, and you can make any comments if you wish. We'd love to get any comments from you, and if you're asking any questions via the blog, we'll be delighted to answer those. So take care. Have a great weekend, everybody. Talk to you next week. Bye-bye.